When we look at CAT, it's not a matter of if it gets breached. We think it's a matter of when it gets breached. We thought that if FINRA or the SEC wanted to do an inquiry, they could simply reach out to the firm electronically, request the information, and 24 to 48 hours, the firm would respond with that information, and that would keep the data out of CAT. But unfortunately, the regulators don't want to move that way. But institutional investors have concerns as well. If somebody were able to go in and link an institutional firm with the trading activity, I think there's a fear that you could potentially see front running in the market, side running in the market, and that there's a lot of nefarious behavior that occur, to the markets in general by the potential breach of this data.
How is the conference going?
The conference has been going very well. On Tuesday, the first day of the event, we spent a lot of time actually in committee meetings in the Listed Options Market Structure Working Group, talking about issues impacting the industry, such as short-dated options, strike listings, and other topics. Gave an update to the Security Traders Retail Committee, which is always a lot of fun, spoke about low-price securities and equities, as well as short-dated options. And then our SIFMA committee meeting, and that all occurs before the conference even starts. The best part about it is seeing, all the people that are here. There's a lot of business that gets done here, important conversations. So I think this is the event that I really look forward to most every year.
What is the health of the overall market?
The markets remain really vibrant. We still see volumes continuing to grow. To date, in 2024, volumes are averaging over 47 million contracts daily. And most important here is the access that investors have. Whether you're trading on your phone, whether you're on a computer, the tools that the retail firms make available, the educational support, the customer service, I think that they really enable people like you and me to make smart decisions, to make intelligent trades. And, I think that's important because there is a narrative out in the media that options can be speculative, akin to gambling. But I think that, the work that the firms have done, the exchanges, OIC, I think that we're in a really good place now. And as in this industry, we continue to address those issues which could impact firms or investors.
What concerns do you have about the expansion of short-dated options to single-name equities?
I think it's important to remember options expire on Fridays now, single names, and Fridays typically have the least news that comes out. We have earnings announcements during the week. Other news comes out, such as, not meeting our production targets that could have an impact on a security. So because of that, stocks tend to be less volatile on a Friday after the close. And I think that that's really important because many retail investors turn their computers off at 4 p.m. However, there's an active after-hours market, and there's still another 90 minutes before exercise and assignments are due at the OCC. And, if there's movement in the underlying security, we could see it go through a number of strike listings. And an investor who thought that their position was out of the money at the close could find themselves, even if it was a hedged position, in a situation where they might be long a call that they've purchased, and then to offset that, they might go short a put. And if there's significant movement in the underlying stock after the market and the price were to go up, they could actually find that their put is now in the money. They could get assigned the security. Their equity, the call, would have expired. And so now when the market opens the next day, an investor could find themselves going out to the market and having to cover that position, which could result in a loss. I think that when you look at things like SPX, SPY, and other ETFs, because they're much broader based indices, the impact of a stock moving after the close is going to have a much smaller impact on the ETF or the index than it would on the individual stock. We need to be very conscious of that risk. I think whether you're a broker-dealer that's managing the risk of your customers, whether you're a customer trading this, I think that we really need to ensure that we're minimizing operational and risk for the firm and continuing to ensure positive experiences for the investor, because if the investor isn't having a good experience in the market, they may not come back the next day to make a trade.
Do you have any concerns about Opera?
There were a series of outages which impacted the market. And, we thought the transparency from Opera was very poor. There wasn't good notification of what was occurring, what the issue was, when the issue was resolved. And as a Reg SCI entity, we do think that Opera should be held to a high operational resiliency standard. We think there should be very strong communication about what the issue is, what the resolution is. And we really weren't seeing that. And it was to the extent that our members were even saying, well, what is Opera? And it's interesting because you have SIAC who runs the operation, New York owns SIAC, and then the administration is done by SIBO. They have a number of staff who do the administration of Opera. So, we realized that we had a lot of questions about it. And one of the things that struck us was that the SIPs in the equity markets have an advisory committee. CAT has an advisory committee. Limit Up, Limit Down does. And we realized that, the industry really has a lot of valuable input that they could share with the exchanges and the operating committee about this. So we contacted Opera towards the end of last year. We've had meetings with them. They did make one modification. They now have a real-time system status alert on their website. But, I think what's most important to us is the advisory committee. And I think we're cautiously optimistic that there will be some changes there, that there will be the formation. And I think that's really important because, a lot of the issues in 2023 we thought were capacity issues. And in February of this year, Opera expanded to 96 channels. One of the things they had been doing annually was a load rebalance on them. And now they've come to us and they've said, can we do this monthly? Can we do this quarterly? What's the proper cadence for it? And you, industry, SIFMA, we'd like you to provide us with input to help us make an intelligent decision. And so I think having more engagement and conversation is something that's very important here. And at the end of the day, should make Opera more resilient considering the industry's reliance on it.
What is your position on CAT fees?
We always thought it would be most fair that whoever originates the order, whether it be, a proprietary trading firm, whether it be an introducing broker, a retail firm, that they should really receive the invoice for that trade. The problem is the way that the model has been adopted, and the model allocates 1/3 of the cost to the executing broker who's purchased the stock, 1/3 to the executing broker who's the seller, and 1/3 to the exchange or FINRA where the trade occurred. And I'll note with FINRA, because they're a nonprofit, they will be looking to recoup those costs, which means the industry will pay about 85% of the total cost of CAT. And the model that was approved by the SEC, which is being challenged by the American Securities Association and Citadel Securities, would put the burden on the executing broker. So instead of having the CAT costs spread evenly against all of the market participants who are initiating that market, instead they're looking at that smaller subset of broker-dealers that are actually the executing brokers executing the trade. And what that means is that it's now going to be those firms' responsibilities to figure out how to recoup those fees from the introducing brokers. So I think, as folks are aware, CAT has been a very, very costly endeavor for the industry. And now on top of that, executing brokers will have to build new systems so that they can recoup these fees when there really could have been a much simpler way to do it. And if CAT is supposed to track the life cycle of an order, we continue to really not understand, as opposed to picking that executing broker in the life cycle of the event, why you couldn't have just picked the introducing broker. broker. The plan that the commission approved back in September 2023 is being challenged in the courts. However, the way it's written, the exchanges and FINRA also have to file their own fee filings with the SEC. And that was done late last year, and the SEC suspended those earlier this year, issued an order instituting proceedings. So the SEC will have well into the third quarter of this year to determine whether to approve or disapprove.
What is the lawsuit against the SEC on CAT?
The lawsuit, the litigation that was just filed, is really focused on the Fourth Amendment. And that's really the government's ability to go in with no reasonable basis to seize personal information from, in this case, from individuals and populate that in this enormous database, which CAT's actually the second largest database after the NSA, and then use that data to determine whether there were any, securities infringements, other bad behavior occurring in the markets. I think from the SIFMA approach, while our members have a lot of concerns about the PII, we've really taken the approach, let's minimize what's being collected with the CAT. And we did a lot of work to eliminate things like our birthdays from CAT, our social security number. So CAT will include name, address, and year of birth. The social security number will be parsed at the firm level, and a CAT customer ID will be put into the system. The methodology will allow each broker-dealer to populate the CAT with the same CAT customer ID. So the SEC, FINRA, the exchanges still have the same ability to do cross-market surveillance and identify where somebody has accounts, but there won't be all that information in CAT. Now, I think what's been most troubling to us is that back in 2020, then SEC Chair Jay Clayton put forth a CAT data security amendment. And in that amendment, they would have required the SROs to do all of their surveillance work in a secure analytical workspace, or a SAW, meaning that no data could be extracted from the CAT. And we thought that was continue to think that's extremely important, because, maintaining the information in one place should be much more secure than having 3,000 individuals, have the ability to take that data out of the CAT. So, we continue to push on CAT data security, the privacy issues, as well as the governance of CAT. I mean, as I said, we have the industry paying for 85% of CAT, but they have no say in anything. And I think similar to Opera, I think industry members have a lot of intelligence about, whether it's data processing, data security, that would be valuable in the CAT and might actually allow the cost to be reduced. We've probably spent close to $500 million on CAT. Having a governance structure like that is something where market participants do have more of a say, could be very important here.
How does CAT work?
The way that CAT is organized, it's actually two distinct databases. So the first database that's up and running is the transaction database. And that includes the life cycle of every order that was initiated in the market, every update to that order, cancellation, or execution. So we have all of that information in one database. And at the end of May, broker-dealers will be required to populate the second database, the customer account information system. And what will happen is that you'll have regulators looking at the trading data. And when they think that there's reason to go into the customer database to look at something, to look at who might be behind that trade, they'll now have the ability to go in and link that trade to the PII to see who's behind that. But I think there are, other concerns because it does have the personal information. I think the regulators could also use it, FINRA potentially to look at, is there elderly fraud going in? You could pick a zip code, pick people of a certain age. So I think it allows them to do some more sophisticated surveillance. But, part of the question is, should they have the ability to do so per the litigation that you mentioned. But I think it is important to remember that, these are two distinct databases, but it's that ability to link that information that really gives it all the power, as well as the ability for the regulators the first time to see, John, if you have accounts at 3 different firms, now they can piece all of that information together.
What are your concerns about the options regulatory fee?
Options regulatory fee is a tariff that's assessed on every trade that clears at the Options Clearing Corp OCC and the customer range. The way that it's structured, each exchange collects a fee. There are 3 different methodologies. The most aggressive one is used by several exchange families, and they actually collect ORF on every trade that occurs in the market, regardless of what exchange it was executed on. There's very little transparency in the filings. It's just not really clear what the money is being spent on. And as I was preparing for our discussion today, I went back and looked at some data that we pulled in 2020 from our members. And what was most interesting was that one of the largest exchanges and one of the smallest exchanges were the top collectors for this firm. It seems unreasonable that investors should be funding this for these for-profit organizations, particularly when they don't really know what it is that they're paying for. In our advocacy, we've talked about having a model whereby, I collect ORF on every transaction in the customer range that occurs only on my exchange. And we think that that's a much fairer way to do it. We don't think that an organization should collect money on day one from activity that occurs elsewhere. I don't really know of any other industries where you're guaranteed to get, a revenue stream the first day you open your doors for business. But because of this structure, you are able to collect ORF. Been told the SEC thinks it's important, exchanges can pay their reg fees, and we would agree with that. But it just seems that there should be much more transparency, fairness. A customer should understand it. It seems really complicated that if you're trading on different exchanges, there's no way to predict what that ORF might be because of the different methodologies. So, we think it's long overdue that the SEC address this. I think that with some new exchanges, I think the SEC is actually actively looking at this now. I'd like to be cautiously optimistic that over time we'll see some changes here because I do think it's long overdue. It's important to mention that it benefits the broker-dealers as well, who have this very complex formula that they use to collect ORF from their customers. And, the one thing they can't do is over-collect from a customer. So it seems that some work could be done to really simplify this.
Do you have concerns about the SEC's equity market rule proposals?
The proposals, a lot of us were left scratching our head. There were these very, very burdensome and potentially disruptive rules that were being introduced, but nobody was able to identify a problem with our current market structure. When we look at the Best X proposal that I think could result in almost every retail transaction being deemed a conflicted transaction, which would really have material impacts on how orders get executed. We're subject to a FINRA Best X rule now. It works well for the firms. It works well for investors. It's written in a way that as the markets evolve, firms can continue to use the new tools and technologies to their advantage to continue to ensure Best X. So we think that rule really isn't necessary. Similarly, the order competition rule that would basically force all retail orders into an on-exchange auction, which is supposed to increase competition. Today retail can send their order to a wholesaler, to an exchange, to an ATS. They have so much choice. Why would we need to force orders into an exchange, into an auction mechanism when there's no guarantee of an execution? And then what do we do with this order? So I think, that's extremely troublesome. The tick size proposal, Reg NMS, I think that one most cautiously optimistic about. SIFMA has advocated for many years for reduction to access fees. Our members are very supportive of stocks trading in half-penny increments, but I think the devil will be in the details there, and it'll be incumbent on the SEC to adopt something that, is supported by the economic data, because I think without that support, there'll be a lot of questions about whether this was really approached properly. The volume-based tiers we find interesting, and I think the SEC looked at it and said, oh, this is so uncompetitive. You have these tiers. They must be disadvantaging smaller broker-dealers. And what was so interesting is we wrote a really strong comment letter opposing that, because even the smaller broker-dealers, they benefit from these tiers. With 16 equity exchanges, 32 ATSs, and other off-exchange liquidity pools to execute in order, the markets are so complex that firms benefit from being able to go through a larger executing broker. Not only do they get more attractive fees, but they also have the ability to, most importantly, leverage the technology from that larger firm. We think that, again, there's no problem here. There could be more disclosure, but to go the step further to eliminate the tiers, we really don't think would benefit the markets. We saw 605 get approved. I think that, that was a good first step. We'd really like to see the SEC pause, as we wrote in our comment letter, use the updated 605 data to determine what other rulemaking may be necessary. But I think if some of these rules do go through, similar to many of the other rules that Gensler has approved this year at the SEC, I think there's a good chance that they'll also be subject to litigation. And I think, the last thing I'll say is the chairs should keep in mind that we have the deepest, most liquid markets in the world. The U.S. capital markets are the envy of the world. So, unless you're really identifying something that's wrong with the market structure, it seems really short-sighted to make tweaks to it, which could actually harm investors in the long run.